Nice to see so many of you here. Taxation. Bit of a health check before we kick this off. So whatever we talk about in the next 20, 30 minutes probably be outdated by the time you walk out of here, depending on what side of bed the Chancellor gets out of today. Similar theme to what Mark covered earlier on. Obviously there was the mini budget a couple of weeks ago. There's a few bits I'm going to cover from the mini budget, but I'm not going to spend a lot of time going to the detail. Hopefully you've seen the budget commentary we've issued. It's all over the press, the news this morning, pressure on the government to sort of, set up plans for filling the gap, managing the debt. Chancellor's due to speak again next month, so what's going to happen in the tax arena, your guess is as good as ours, I guess. But we'll cover a few points here from the budget, and then we're going to spend a bit of time talking about a couple of areas lots of our clients are asking us questions around, they've got a lot of interest in, being the super deduction, where there's still an opportunity to maximise capital allowances. There's a few nuances around that, so we'll go through that. And also the employment tax arena, and we'll cover IR35 there as well. Just a few bits that I do want to cover though, the boxes in red. You all know the CT rates due to stay at 19% now, but I just wanted to raise the deferred tax implications of that. Most of your balance sheets, I presume, have calculated deferred tax at 25% at the minute, and that will need to continue until the 19% is enacted, which we don't know when, but it should be soon. So you continue recognising at 25%. If it's materially different to your 19%, you potentially will need a disclosure in your accounts. I guess when there is a change to 19% and when you drop recognition down from 25%, just worth thinking about if you're sitting on significant deferred tax assets, being a DB scheme, tax losses, for example, there will be a hit to your reserves, there will be a hit to your effective tax rate, so just be aware of that. You could have banking covenants that are based on net assets, for example. It's just worth flagging that. IR35, again, it's boxed in red, but we'll cover that shortly. Annual investment allowance. So we'll talk about super deduction, but the annual investment allowance has been around for many years, and that's been changing all the time as well. I think it was low as 50,000 at one point. Change, went up to 200,000, has been £1 million for a few years now. It was due to drop down to 200,000 next April. Super deduction expires come end of March next year, so annual investment down to 200,000, but the government announced that it will be £1 million indefinitely. So again, worth factoring that in when you're planning for CapEx. We've got a box down there called Quips. What's that about? So it's around tax payments. So typically, you pay tax 9 months after the year end. If you've got taxable profits of say more than 10 million or 1.5 million, or basically above 1.5 million, you have to pay tax in quarterly instalments. And the limits, that 1.5 million, well, if it's above 1.5 million, you pay in instalments in the second year that you breach that limit. If it's above 10 million, you pay quarterly instalments in that year. Those limits effectively are divided by the number of 51% active companies within the group. There has been talk about the rules changing and going to an associated company definition, which could hit those structures where you've got common shareholders investing in two different groups. We'd have to bring in all of those active companies. And what does that mean is, well, actually your limits go down low, more companies could be paying tax earlier. And that's basically what it could mean. That's been speculation. We're not sure that will happen, so it'll probably stick to 51% group companies, but let's watch this space. The final point I wanted to cover was corporate interest restriction, which has nothing to do with the mini budget. Some of you may be aware that this came in 2017, which basically restricts the interest deductions a group can claim in the UK. And broadly, if you've got interest deductions of more than 2 million, it's capped at 30% of your tax EBITDA. There are lots of weird and wonderful calculations behind that, but that's broadly what it is. There are instances where if you've got net interest deductions of less than 2 million, this can still kick in. And the main example that I've come across with a number of clients is where you've got rolled up interest. So you might have a management debt, you might have private equity debt in your structure. You're below 2 million, so you think it's not an issue, but you're not claiming all of the interest in the year it's accrued. So for example, you might have, your P&L charge might be £1 million for interest. You're only claiming half of that, say 500,000, because 500,000 is being deferred for tax relief because it's due to a PE house. And you think, actually, we're still below 2 million, so what's the point? The point is that 500,000 you're deferring for tax relief In 3 years' time, 4 years' time, when you go to pay it, you're going to be seeking a deduction of more than 2 million. And then you might have an issue around CIR because you might not get full relief for that. And think, okay, fine, that's 3 years down the line. Why are we worried about it today? There are things that can be done today in the year that the interest is being deferred where you might be able to increase that 2 million cap in 3-4 years' time. And that's why it's important to look at this. There are a couple of caveats around that. So anything you can bank now to increase that cap in the future, it has to be used within 5 years on a rolling basis. So December 22 year end, if there is excess capacity under CIR, you'd have to use it by 2027. And the second point is you would need to submit a return to HMRC. So I guess the takeaway around this is if you're above 2 million with your interest deductions, it probably already kicks in for you, you'll be aware of it. If it's below 2 million in your interest costs and you're claiming everything in the year it's accrued, it's probably a non-point. But if you've got rolled up interest that you're going to get relief on in the future, probably needs looking at. So I just wanted to raise that. It's a bit of a flavour. I'm going to pass over to my colleague Nathan, who's going to talk about employment taxes.
Morning everyone, I'm Nathan from the employment taxes team here at Cooper Parry. What I wanted to do for the next few minutes was kind of give an update on employment taxes, which has kind of seen quite a few change over the past few years and especially over the past few weeks. And one of them, which is a major talking point, is R35, which is the rules will essentially go back to what they were in the year 2000. And so you're probably thinking two things. One, what is R35? And two, there is no way Nathan was working in the year 2000, which is true, wasn't it? But so with R35, kind of just bringing it to where it came from to where it is now, HMRC were concerned that in, let's say, in the 90s, there were individuals who were working like employees, doing exactly the same things as employees, but simply because they were being paid through their own limited company, that they were able to pay less income tax and less national insurance. And then the business that was paying them was also paying less national insurance. So it's kind of like a win-win for the individual and the employer, and HMRC were losing out. So in the year 2000, HMRC brought in these rules called R35, which essentially means that if an individual was working like an employee, but working through their own company, that individual has to pay the same amount of taxes that the employee would have had to pay. And so what happened over the next 20 years is a lot of contractors or consultants, they go by various names, were able to pay significantly less tax, but they're working like employees. And so HMRC then thought, well, instead of actually trying to locate all of these contractors, why don't we just change who's responsible for applying these rules and paying the tax over? And so then from April 2017, in the public sector, HMRC made the public sector business responsible for applying these rules, which essentially means that the business who's paying them is liable for the tax and national insurance. And then from April 21, after a 12-month delay, HMRC then applied those exact same rules to the private sector. And as a massive change in responsibility, and then from April 21 till as of now, all businesses had to really identify all their contractors, assess them, and make sure that they were paying the correct amount of tax. And then a few weeks ago, to much of our surprise in the tax industry, HMRC kind of went back on those rules and said, well, actually, from April 23, the rules will go back to as they were before. So contractors will be responsible for doing their own tests and paying their own tax and national insurance. It's a bit of a step back in time with that one. But I think the strange question is what does that mean for businesses and the contractors? Because if you have a business now who's assessed contractors, you think they are caught by these rules, so they have to pay more tax and national insurance. Well then from next April, the contractor can then just go back to paying less tax because they're happy to run the risk. So it kind of raises more questions than it answers in that respect, but it's definitely one to be aware of, that if you currently engage contractors and you have assessed them, that from April, it's their responsibility, but from a business perspective, you might still choose to engage them on the payroll anyway, just to kind of manage your own risk. The next point, which I'll kind of cover off quickly, is the health and social care levy. So from April 23, actually no, from the start of this year, there was an increase in NIC rates of 1.25%, and that was a cost to the employer and individuals, and that was to cover the health and social care levy. And HMRC will remove that from the 6th of November this year. So anyone who's paid after the 6th of November, the NIC rates will go back to as they were last year, which is good news, hopefully. The third point, that's pretty much a similar thing. So with the health and social care levy, what HMRC did is, because it was an in-year change, they just changed the NIC rates. Then the intention was from April 23, they'd break it down separately, like the apprenticeship levy, but essentially, the main thing is, from November, the NIC rates will go back to as they were last year. We're also seeing an increase in activity from HMRC, and I think it's a mixture of them trying to, of course, increase the tax and NIC that they get in, but also they're really interested in what sorts of benefits and expenses individuals were provided with when they're working from home during COVID. And so we're seeing a lot of interest from HMRC in doing employment tax reviews, and also similar with VAT as well. So it's worth just having a quick check internally that anything that's provided to employees is done in the correct way and also the most efficient way as well. One question we always get asked in employment tax is, how can we give employees more in a much more efficient way? And there's various ways to do that, but I'd say the main popular ones to consider is tax exempt benefits, which can be things like Christmas parties, even travelling allowances if they're working away. These sorts of things can be paid tax and IC free to employees as long as they meet various conditions. And another one, which we're seeing a lot of interest in, is salary sacrifice schemes, and that's things such as pension contributions, cycle to work scheme as well, which is where employees can give up part of their salary in exchange for a benefit, and by doing that, the employee will make a saving, and so will the business as well. That's always one to consider if you're always considering what can we do to give employees more, but in a tax and NIC efficient way. And the final point I wanted to mention is simply changing the timing of when you pay people as well can deliver a saving, especially with the income tax rates reducing from next year. By delaying payments that employees aren't contracted to receive next year, they can pay a bit less tax as well. And also one thing I did want to mention, just popped into my head, is not many employers pay the use of home allowance, which is the £6 per week. So if you did want to pay employees for physically working at home, that is something you can pay as well, which would be £312 a year, tax and IC free, and that's another way that you can get more into employees' pockets in a tax efficient way. But yeah, that was a quick one for me really. We'll stop talk. I'll pass you on to my colleague Ronak.
Good morning all. My name is Ronak Shah. I head up the Cap Allowances team here at Parry, and just spent a few minutes this morning just discussing about the super deduction. Obviously, I'm sure all of you are aware of exactly what it is, you know, the relief that is available. I'll start with a very kind of quick recap on some of the key points, but I then kind of more delve into some of the kind of the key traps and the pitfalls that are there, and that may not be that obvious unless you look at the legislation in a lot of detail, and of course you incur the relevant capital expenditure as well. So very quickly, as I'm sure everyone knows, it's the main headline rate was that it was 130% relief on certain assets, and capex has to be incurred in the 2-year window, so from the 1st of April 2021 to the 31st of March 2023. Contracts have to be entered into with a contractor from the 3rd of March 2021 onwards as well. And as Bijesh said earlier, that it is scheduled to end on the 31st of March next year. There was a vague kind of statement in the growth plan that mentioned that there'll be some tweaks to the regime, and some people have assumed that actually that could it could mean that it's going to extend and continue. It's probably not going to be the case, and hopefully there'll be some more clarity on that going forwards. But I think it's more to do with tweaks in the disposal values or where you've claimed the super deduction on certain assets. The main thing though, because as CT rates are going to remain at 19%, this is actually now an absolute relief where it is time critical. So where you've got capital expenditure plans, and you are looking to incur that capex, now is the time to think about it, to take advantage of this relief. The big thing though is really how super is the super deduction, and when you delve into the detail and you look at the legislation and the kind of the key conditions, there's actually a lot of areas that are not great, and you could fall foul of them. So I'll go through a few of them just here. So the first thing is obviously where you've got accounting periods that straddle the end of the super deduction date, the actual 130% rate will be prorated, so you won't get the full 30% uplift in the tax relief. The big thing though, and I've had a lot of queries from our existing client base on this, is you actually have to legally own the asset in this 2-year window, and that's really a key thing. So you have to legally own the asset and be used in the course of your trade. Now, we've had a lot of queries from clients where they're looking to purchase equipment, plant machinery, and they're looking to spread the payments. And in those scenarios, a lot of the times they ask the question, can we still claim the super deduction, even on some of the payments perhaps that have been incurred pre-31st of March 2023? And the answer to that is it really depends. It depends on when you actually legally own the asset. In a lot of those kind of contractual arrangements, the asset tends to get, the company only legally owns the asset after the final payment. And if that final payment is after the super deduction window, then according to the rules, you won't be able to claim the super deduction. So it's a big thing to consider. Conversely though, if you are looking at kind of stage payments for an asset, and you're going down the kind of the finance route, hire purchase agreements could be an option in terms of, there are a couple of other conditions, to satisfy for the super deduction, but as long as they are, in hire purchase agreements, any future obligation and any future payments can all be rolled up in day one. So as long as you start the hire purchase agreement in this window, you can actually claim the super deduction in full on that, because under these rules you legally own the asset from day one for capital allowance purposes. And there's the key thing about capital allowances, and you may have come across this phrase, kind of when the obligation to pay becomes unconditional. So what that basically means is kind of when can you actually recognise that payment in your fixed assets and in your accounts. Now, in capital allowances kind of lingo, that obligation to pay becomes unconditional when the asset has either been delivered to your premises, or is in use in your trade, or the invoice date. Now, a tax planning opportunity here, if you want to take advantage of the super deduction, is that there is a quirk in the legislation for capital allowances where if your payment date of an invoice is more than 4 months after the invoice date, then the obligation to pay, the obligation to pay where it becomes unconditional is actually on that latter date. So, for example, if you have an invoice in March 2023, but you don't make payment of that, say 3 months later, you can still recognise that payment in your March fixed assets, and therefore potentially claim the super deduction. So it's just something to bear in mind. And as I mentioned earlier, in terms of kind of what the tweaks to the super deduction may be for following the CT rate remaining at 19%, we and I suspect that it will be to do with the disposal value. So where the existing rules for super deduction was where if you claimed the super deduction on an asset and you disposed of it, depending on when you disposed of it, it would automatically go to a balancing charge. And that balancing charge could be as high as 130%, so the full amount of relief that you received, or it would be prorated depending on kind of your accounting year end. Whereas now, because the CT rates are going to remain at 19%, we suspect that balancing charge will be at the full 130%. So something to bear in mind. Obviously, if it is related to a fixture in a building, that balancing charge can be overridden by a 198 election. And therefore that disposal value can be as low as £2 to as high as the original cost. So something to bear in mind there as well. And then finally, in terms of leased assets as well, where you have bought an asset and you then lease that asset to either a connected company or someone else, first year allowances are typically not available, and that would include the super deduction. There is one exception where if the asset that you lease is is akin to more of a service than just hiring of an asset, then you can claim the super deduction. And we've had, I've had a lot of, I've had a couple of queries regarding clients who, in the construction sector, who will purchase an asset, that they'll then lease that asset to a company that's in their umbrella, and they'll ask the question, can they claim the super deduction? And as long as there's some kind of a service involved with that leasing, and you can prove it, and there's evidence, then you will be able to claim the super deduction. So that's just some of the kind of the key kind of traps and things to be wary of.
Hello. Okay, so let's get restarted. I'm Chris Knott. I'm a partner here at Parry, and I head up what's now the CP Innovation team. We were R&D incentives. All will become clearer as we go on. So today I'm going to talk about a few things. So there's a fair bit to get through. All things innovation, cash flow, and some of the other things you'll be glad to hear that you should be considering and looking at. We'll also touch on the new rules for R&D incentives, when they're going to come in, what kind of effect they're going to have. Then look at the current HMRC environment. Fair to say they've upped their game quite significantly recently, so we'll have a look through what they're up to. And lastly, the national stats came out a couple of weeks ago, as they do annually, so we'll have a look at some of the trends and what they are showing us. So the first bit, so the innovation cash flow. What we did, so we ourselves changed from being R&D incentives when we were part of tax. That changed year end for us, 30th of April. So from the 1st of May onwards, we've been a separate department of our own. So one of the things we thought about was, well, what actually do we need to be providing to the market? What do our clients need to be thinking about? And so it's all about cash ultimately, and the cash that funds your innovation. And the R&D incentive bit is just, it's a fairly large part, but it's a bit that's just part of that whole innovation life cycle. So you'll be glad to hear today, I'm not going to go through, as we have many times before, and there's a fair few of our clients in the room anyway, I'm not going to go through the R&D rules, nothing to do with the criteria. I can see it cheer, PPI salesman of tax and all that. We know. Or pound box. So what I'm going to focus on today, just give you a bit more information about what we're seeing and who we're sort of talking to and who we can put you in touch with, is the grant side and the university support. There are a couple of those areas around the circle that you may not have considered, may not be fully aware of, because being brutally honest, a lot of us weren't to the extent we now are. So the first one is all about the grants that are available. So these largely split into two main buckets. There's the larger innovation funding service stuff, which is essentially the larger bits and pieces. They tend to be 100k plus. And they can all be found literally on the government's Innovation Funding Service website. So you can go and have a look. As of yesterday, and it changes daily, there were 42 competitions that were live on all sorts of things, specifically to do with areas, sectors, etc. There's a couple of agriculture and farming ones on there at the moment. The main one that I've got up there as a link, and I've done my slides as a bit of a template so you can remember next week what we said, is the Innovate UK Smart Grant. So these come out quite often and quite periodically. And the wording that they use there talks about there being disruptive innovations that are going to deliver significant and rapid economic growth for the UK. So disruptive innovations, that sounds vaguely familiar, doesn't it? In fact, I said I wasn't going to touch on the R&D criteria and I won't, but anybody that's claiming will know that sounds broadly, semantically familiar. That one scheme is probably a bit late for that one. It ends at the end of October, but we've already been told by our friends at Innovate UK that there's a new set coming out in November. So this is what tends to happen. There's a kind of 3-month window for each of these sets of smart awards. 25 million in the pot for that one. For projects that are 6 to 12 months, you can get anything from 100k to 500k. For projects that are 9 months through to 36 months, it's anything from 100k to 2 million. So there's a fair amount sat there, and the definition's quite wide. So it's worth going and having a look at. At the smaller end, you've got the local enterprise partnerships, so the LEPs. There's 38 of those around the country. It is just an England thing. There isn't any in Wales, there's none up in Scotland. So of the 38, there's a Derby and Nottingham one, there's a Leicester one, there's a Greater Birmingham and Solihull one, there's a Black Country one. So there's a few that are based around here, and they tend to be at that kind of sub 100, but to be brutally honest, it's largely in that 5 to 20k region, and they're for a lot of the usual kind of things. They're very similar kind of things as we've talked about already for the large ones. So worth going and having a look at both of those websites, especially the one at the top. University support is the other area I want to touch on today that people seem to know less about. And so we've been speaking to Birmingham Uni, we're now in touch with Nottingham and finding out some of this stuff and quite how much is there. So there's a whole raft of business support programs that these universities are involved with and are putting out in the market and waiting for people to come and take up free professor time, free student time on projects that you're finding a bit sticky. Yes, you've got your knowledge and your experience, but actually academically, is there a bit of a boost that we can have in terms of tapping into those guys and helping get that project or that thought over the line? Usually 2 or 3 days, it's free. There's nothing to lose in terms of reaching out to those guys. I actually got sent a list of 16 at the moment from the Birmingham Uni guys in terms of what's out there, and I just chose these 3 for obvious reasons in terms of kind of with R&D innovation hat on. Zero carbon products and new products and processes, and advanced manufacturing technologies. There's an awful lot of R&D claimants in the room, people who are doing that kind of thing almost on a daily basis, that again, it's worth tapping into the unis and just seeing what's there in terms of help for your projects. The other things worth mentioning that I haven't got on there is knowledge transfer partnerships, which is essentially a 3-way collaboration between the company, the university and a student. And again, they talk a lot about innovative, scientific and technological projects. We're hitting a bit of a theme here, aren't we? It's just what words they're choosing to use. And again, they give a lot of help in terms of what they're doing with those projects. So they're looking for those projects that effectively deliver impact and growth. That's the thing that they look about in terms of KTPs. So all broadly very similar. Moving on to the new rules for R&D incentives. So as we know with all things budget, these aren't set in stone yet. There's been 2 consultations already, and there's a long way to go before we get to April next year. So I'm just going to run through some of the changes that are in play at the moment. These may not be what actually goes live when we get to next year. One of the first things to note is, yes, it's from the 1st of April next year, but it's for accounting periods beginning on or after that date. So actually these won't come into play, which is moderately irritating for some of the cost category changes and widenings. Because if you're March year end, it won't be till March 24, December it won't be till December 24. That it will actually hit and impact you and you'll be able to include these. Let's say, moderately annoying. Data and cloud costs, so they dragged themselves kicking and screaming into the 21st century, and they're now allowing us to include the likes of data and cloud computing costs. So data is essentially license costs, storage costs for access to that digital data. Cloud computing costs, everything from software platforms, hardware facilities, data storage, all of that's now going to be allowed to be included, but not yet. Pure mathematics, a lot of stuff that we're seeing across a lot of industries to do with largely artificial intelligence, a bit of quantum computing, but we don't see a lot of that. But mainly AI, pure mathematics, that's now allowed to be included. One of the things that they are getting quite uppity about is the rate of return, I guess, for the amount of R&D spend, and we'll get onto the stats in terms of what it's now costing the Treasury. Are they getting a decent return, and is that return here in the UK, or is there too much of a drain, rhetorical, they believe there is, going overseas? And so one of the things they're looking at is overseas expenditure being included within claims. It hits some sectors more than others, particularly someone like, for instance, the software sector. There's a lot of companies who maybe haven't got staff in the UK, but they've actually got subcontractors that are overseas. The bottom line at the moment is they are all out now. So you're not allowed to include any of those. So there's been quite a lot of uproar from various sectors, as you can imagine. And so they already now brought in a couple of the exemptions that are listed up there. Material regulatory requirement, etc. Cost is not an allowable reason to be able to include them. Clearly there's enough grey there for those to be challenged at some point, so it'll be interesting to see exactly how they land wording-wise when we get to the actual legislation. I'll go on to kind of the current HMRC environment in a minute, but this is largely what it's driven by in terms of so far specifics that they've put in place. Tackling abuse, there's a lot of it in our industry. We have a pretty bad reputation, which saddens and pains me having done this for 22 years and see the scheme as my baby. Having helped to write some of the legislation. So there's far too much of it going on, and so we're very much welcoming some of this. And so what they're bringing in, a bit like various things over the years, there's now going to have to be a senior company officer signing off on the return that your R&D claim is correct. So sending a bit of a shiver through some of the industry in terms of kind of a lot of the senior company officers probably don't even look at the claim. And so now they're actually signing it off as being correct. That might mean a few people taking a bit of a closer look. Disclosure of the company's R&D advisor. They're trying to improve their data set. Anybody who thinks HMRC don't have a list of naughty boys and girls already in terms of R&D boutiques, naive. They clearly do. They just can't tell us they do on record. But their data set's rubbish. So what they need to do is kind of, okay, how many claims have that particular boutique that we don't like the look of put in? Don't know at the moment. So you're now going to have to tell them who you're using. So that link to the one above should give a bit of food for thought. So the last one I don't like, and I've already started lobbying them around this, pre-notification of intention to claim. You've got to do it within 6 months of the year end. So I have asked the question, well, how does that line up with a company up there that's not aware they're doing R&D because it's not really R&D? That's a discussion for a different day, and there's plenty of articles online if you want to go read them, written by someone. 6 months. So if you haven't heard, you don't realise you qualify. If you don't realise you qualify within 6 months year end, you've gone. So never mind the normal 2 years that you've got for making or amending a claim, that's now out the window going forward. You've only got 6 months. So they're really trying to limit the amount of claims, and again, we'll get to the stats and you'll maybe see why. There is an exemption. So my client's in the room going, God. You have an exemption where you've made a claim within any of the last 3 accounting periods. So you're okay if you're in the game already. So it's hammering the newbies, but again, we'll see why when we get to the stat. Current HMRC environment. They finally found their let's use voice, and it was probably well overdue in terms of what's going on in the industry. We've got a very bad reputation as a collective. So HMRC finally wanted to do something about it, probably because it's starting to cost a bit too much. So the first thing they've done is brought on 100 new R&D inspectors. So we see this quite, having done this for 22 years since it started, this is a bit of a cycle. They kind of let it lapse, and there's other things like COVID and furlough to kind of deal with, so inspectors get pulled off onto that. And they realise, hang on a minute, we haven't asked enough questions about the R&D, so we'll bring another raft of new inspectors on. The issue with a load of new inspectors is the very easiest way to train them is to get them asking questions and making inquiries, and that's, nobody particularly likes that. We ourselves have had 5 or 6 in the last 6 months, and that's more than we had in the first 5 years I was here since I set the team up. So they are definitely putting themselves about. They've taken 2 cases to court recently. We've not seen that ever until last year and this. One was a fraud case, and the second one they challenged the definition of subcontracting from a large company. So anybody who does projects for the likes of JLR or BAE Systems as an SME, they're suddenly now not liking that and trying to make out that that's subsidised. We're saying that's rubbish. Because effectively all SME claims are out if that's the case. So they did lose that one. They got a bloody nose, which was good to see, but they've already said that they still maintain their position in terms of their interpretation of their own legislation, of their own guidance based on legislation. So they're probably looking for another one to have another go. They recently got the Fraud Investigation Service involved. These were some very nasty letters that got sent out in June. There was 200 of them, and they basically said, we don't believe your claim, we believe it's fraudulent, your one option is to withdraw it. We'll consider penalties with how quickly you withdraw it. If you argue back, thanks, we'll take that as evidence for your tribunal stroke prosecution. So thankfully none of ours got one of those claims. But we've heard about them, and yeah, there was some talk of them all being software based and all being under 100k. They weren't, because I've seen an engineering one that's over 100k from someone else. So yeah, they were nasty, and so you didn't want to get one of those. But it just shows that they are prepared to get the big departments involved in terms of sorting this out. What we've now heard is 2 more rafts of letters. So the first one we're calling the kind of nudge letters to claimants. There were 2,000 of these, and so these went out about 2 months ago. These are slightly softer, but in a very kind of passive-aggressive way. Basically said, here's a list. These are links to the rules. Can you have a look and read them and make sure that you still think you qualify? They're subtle. So I think they're waiting to hear back in terms of how many claims get withdrawn off the back of that. The bottom one, we keep getting sent by HMRC because we've been involved with the Institute of Tax, etc., in terms of what we do to kind of clean up the sector. We get to see about these beforehand, and the bottom one is a new letter that's about to come out. We called it iffy sectors. I don't know what else to call it. Seems close enough. So this is going out to. There are R&D specialist boutiques who basically badge themselves as the specialist for the care home sector. No R&D in care homes, and so but there are boutiques who have made making their living at the moment based on R&D claims for care homes. They are one of the sectors that have been highlighted as you will be getting an iffy letter if you are making a claim from that sector. So they're trying, and good, long overdue, and so hopefully. They start to make it a little bit more difficult, because ultimately over the last few years all of the good juicy stuff of the tax legislation has been legislated against. So gold coins, PRP, all that kind of stuff. It's all gone. We're the best bit left, and so it's attracted the sharks. Well, waters need cleaning up, don't they? So on to the final section for me. And so the national stats, these came out on the 29th of September. For the first time in 22 years there's been a reduction in the level of support claimed, down to 6.6 billion, probably largely due to, because this was covering 2021, this would have been the first year that was including things like COVID, furlough. Everybody knows that the vast majority, the largest element of R&D claim is the staff costs, and if the staff are sat at home on furlough, they can't be in the factory or in the environment in the lab doing qualifying activity, can they? So that wasn't a great surprise. But what else did they tell us? The number of claims had gone up by 7% to 89,000, whilst having a reduction in the value. So effectively there's essentially been a 10% reduction in the average claim. Largely off the back of 7% increase in the SME market, and the next two stats stagger me. And just shows exactly why they're doing what they're doing. 72% of all claims have a cost value, so the benefit to the company is less than 50 grand. The bottom one's even worse. 18% of all claims, 16,000 claims nearly, cost value of under 5k. Even if you're an SME, so if you're an SME, that's about 20 grand of cost, 25% benefit. I'd challenge anybody to be doing anything that's appreciably improving your product or process if you're only spending 20 grand. It's just not really possible, is it? To that extent. That 18% of the 6.6 billion costs 35 million. And so, that's a big number to be wasting, but actually from an HMRC time and focus and attention, you've got 18% of your cost for 0.5% of your value. Disproportionate, clearly. And so that talks to everything we've said in terms of why they're ramping up, why they're looking at it, why they're getting a bit more uppity. It's there in black and white, well, in green and burgundy. But, so that's it from me. No, it isn't. One final one in terms of the Midlands itself. So these are the number of claims from East and West Mids. And it's just more of the same backup. So 8% increase in claims, benefit value was exactly the same last year. So it was only about 5,700 claims last year. So again, average claim value's gone down. West Midlands, even worse. Increase in claims. The benefit value last year was 475. So we've seen a decrease. So just a lot more of that stuff. Yes, some of that's going to be the reduction to the larger claims through COVID, but just a lot more of those lower value claims coming in at the bottom end. On the right hand side, that's the, so that is finally, that's the various sectors, just to show where the claims are made from. Largest one, that J, information and communication, that's basically the IT claims, largely driven by London market. The manufacturing, obvious, I guess. The thing pointing out, professional, scientific and technological, what the hell does that mean? That's effectively your engineering. So your automotive, aerospace, if it isn't in manufacturing, it'll be in there. And so I guess for the Midlands, good old-fashioned engineering, manufacturing type companies, that's exactly where you'd expect there to be a lot of claims. The things worth pointing out, just going back a slide, 89,300 R&D claims, there's only just over 1,500 patent box claims. So I'm not going to go through the definition, as I said, but if you've got 89,000 companies who are doing R&D and create something that's appreciably improved on what was already there, appreciable improvement, prior art, semantics, why is there only 1,500 patent box claims? So again, I think that's a very underused area that it might actually be worth going and having a look at. So that is it from me.
Okay, so thanks for the intro, Chris, but not all things Russian, that's a bit of it. So I'm here for your technical update today, so got a few various bits and bobs to cover off basically. There's a bit of variety in there. One point on it is around sanctions and in particular the situation in Russia. ECR Professional help us pull the materials together, so that's just a brief disclaimer from them. So in terms of the things to cover, the first bit I'm going to cover is a bit of an update and a bit of a reminder really around going concern and banking covenants. There's then a bit on periodic review of UK standards, some updates on corporate transparency and reform, some FRC guidance on the strategic report that's recently come out, and then the section that Chris was referring to on sanctions. Okay, so in terms of going concern, I'm sure you're all aware over the last probably 2 years there's been a lot of focus around going concern as a result of the pandemic and varying situations. Obviously that's set to continue with everything you've heard this morning about the economy and the impending recessionary period. So we just wanted a quick reminder in here around directors' duties and what people like your auditors will be looking for. So as directors, it's their duty to assess whether the company will continue as a going concern for the foreseeable future. What that means in practice is at least a period of 12 months from the date of signing your accounts. So that's what your auditors will be looking at when they come in. Obviously, as you've heard, we're in a very different world these days, so gone are the days when your forecasts can include costs going up at a standard 3% for the next 12 to 18 months. There needs to be a little bit more thought, a little bit more actually what do we think is going to happen. Obviously, it's all going to be on assumptions. No one's got a crystal ball. It is very uncertain at the minute, as you've heard. So what often is useful is planning different scenarios and equally stress testing those scenarios. So you might have optimistic and pessimistic scenarios. You might have even break case scenarios in terms of what does cause a problem. So it's useful to think about what could happen under different circumstances with the myriad of possibilities of what will happen in the economy. What's your kind of best case, worst case scenario there? But equally, when you're thinking about that worst case, start to think about what mitigating actions you could take. So you wouldn't just carry on as before and let it all go. You would do something to kind of rein that back in, mitigate that risk. One final point on going concern and related, think about if you've got debt, if there's covenants on that debt. As we've heard, interest rates are likely to continue to rise. So there will be an impact in terms of going concern forecasts from that interest, but equally, if you've got covenants, financial covenants on your borrowings, you need to be thinking about whether you're forecasting to breach any of those covenants. Typically, even if your lender is quite relaxed about waiving those covenants or amending those covenants, you need to be a little bit more on the front foot with that. If you get to your year end and you've breached your covenant, if you haven't got a waiver or amendment that's already in place at that year end date, the debt will need reclassing to due on demand if that's the impact of breaching your covenant. So just want to think about, as you get close to year ends, think about where you are, be talking to your lenders early, basically is the message. Okay, moving on to periodic review of UK standards. So as you're probably aware, the FRC have been continuing to periodically review the UK standards. They put something out in April this year around that periodic review, and they've been receiving comments back on that. They've had around 450 comments so far. Broadly, people think the standards are working. They think they're doing what they need to do. There's a few suggestions for improvement around things like accounting for grants, which is probably to be expected after the heavy use of furlough, and things like share-based payments. Key things that they're talking about bringing into FRS 102 are the recent changes in IFRS. So IFRS 15 in the revenue standard, again, depending on the industry you're in, will have different impacts. So where your revenue streams are relatively simple product delivery, it will have very little impact, but where you do any kind of contract accounting, there'll be more to think around how you unbundle different elements of that contract, what performance obligations are in that contract, and how you measure when those performance obligations are achieved. So that's one thing that's likely to come in. Another big issue is the lease accounting standard that came into IFRS a couple of years ago. So IFRS 16 brings all the leases onto your balance sheet, whether they're finance leases or operating leases. Again, that was a huge disruption in certain industries such as retailers, where there's a large portfolio of leasehold properties when it came into IFRS, so we'd expect to see a similar level of activity if it comes into FRS 102. So key things to think about there is, where is your leasing data? Do you have a central data set that you'd be able to use if that does come in? Do you have all the detail in that data set? Because you will need to think about things like break clauses and rent escalations and other terms within those leases when you're accounting for them. Broadly, the FRC are seeing support for both of those bits coming in to FRS 102, but with some suitable simplification around level of disclosures and things like that. There has been mixed feedback around bringing in the IFRS 9 element, so the expected credit loss models around financial assets. So that still remains to be seen. In terms of progress on this and where we're going with it timeline-wise, there's an exposure draft that is due imminently. It was not due before September this year. Well, obviously we're in October and it's not landed yet. Once that exposure draft lands, there'll be a public consultation period of at least 3 months. And then once it's finalised, it will need to be at least 12 months before implementation date. And it definitely won't be effective before periods commencing on or after January 25. So there's a little bit of time to plan, depending when they come out with final versions. Okay, next bit is corporate transparency, and this is a white paper that came out in February this year. It's been out for consultation quite a long time now, and they're still gathering feedback on it. And largely the purpose of that is to grant Companies House some more powers and improve the transparency around things like corporate ownership. The proposal is that Companies House will have an ID verification process, so there'll be digital identity verification for anyone who's listed as a person of significant control on companies and on directors. So that will be one element of it. There's also more proposals around corporate directors and getting rid of those corporate directors, which I know has been talked about for a long time. Typically, if corporate directors are still in existence, those corporate directors have to have natural directors above them, so there can't be multiple levels. Companies House are proposed to have more querying power. At the minute, Companies House have to accept information delivered to them. Relatively speaking, they don't challenge a lot. they're proposed to have more querying power and be allowed to query more of what they get. So that's another proposal. And then in terms of transparency of ownership, there are proposals that companies will have to issue a full list of shareholders. That would then be updated annually just for changes on your confirmation statement, but in the first instance there would have to be a complete list of shareholders, and those shareholders would then be subject to the ID verification process I mentioned. And then in terms of improving financial information, I know previously it's been talked about that they were proposing to change filing deadlines. This white paper says they're no longer proposing to change those at the minute. And I think that's partly due to all the COVID delays, and some entities are still struggling to get them in within the current deadlines. So they've scrapped that for now, but they have said they will review it in future. However, there is some anecdotal talk of them scrapping the loophole that some of you may be aware of around unlimited ability to shorten your period end. There's always been restrictions on how often you lengthen your accounting period, but currently there's no restriction on how often you shorten it. And each time you shorten it, it buys you 3 extra months to file your accounts. So a number of entities have used that to shorten and buy some time in periods of disruption. So that might go away. And then the final point on improving financial information is around small entities and micro entities. So they're proposing to get rid of the abridged or filleted version of accounts. So all small companies will then file a profit and loss account, including micro entities, and small entities will have to file a director's report. So just want to be aware of. Okay. And then the FRC have put some guidance out around strategic reports. So this replaces the guidance that came out in 2018, which gave a new raft of disclosure requirements around that strategic report. There's not loads of changes to talk about. It covers all entities that are currently required to provide a strategic report. The main changes are certain entities will need to give climate-related disclosures, and I'll come on to what they look like. But the entities that need to do that are public interest entities, AIM-listed entities where you have 500 or more employees, or private companies that have turnover of 500 million or more and more than 500 employees. So again, they're trying to capture those larger private businesses as well as the full list businesses. There's also some updates to the streamlined energy and carbon reporting guidance, which is contained within an appendix to that guidance document in the director's report disclosure requirements. In terms of those climate-related disclosure requirements that I mentioned, that is going to be more discursive and be around the risks and opportunities of climate change. So thinking about your strategy as a business if we enter a low carbon economy, things that might change as climate change progresses. So thinking about things like, should your assets need more replacement or maintenance because of increased weather events, floods, droughts, whatever that may be. So it's a bit of a SWOT analysis, if you like, and how you would put that into some narrative disclosure. They will also be expecting some climate-related KPIs just to assist in kind of scenario projections, things like that, in that disclosure. The only other changes are minor changes around definition of PI, public interest entity, post-Brexit, and typographical presentational changes. So not a lot else in there. It is mainly around the climate-related items. Okay. So moving on to sanctions, and this is where Russia comes in, as you may expect. So there are a number of different types of sanctions. We will mainly focus on financial sanctions this morning, but the others are up there for reference. Key thing to say here is there are obviously some fairly hefty penalties surrounding dealing with parties that are sanctioned. So you just need to have an awareness of this, really. In terms of financial sanctions, the purpose of financial sanctions is to manage behaviour. as you might expect, restrict access to resources and show disapproval, so basically make it clear that these people shouldn't be dealt with, or these entities. There's a few different types, so asset freezers, restrictions on markets and services, or cessation of businesses. And in terms of who must comply, it's anyone within the UK territory, UK nationals, or entities anywhere in the world. And as I said, there are some fairly hefty penalties around for this, so we just want to be aware of. Sanctions are imposed by national governments, but also from higher bodies such as the UN. In terms of how you find out around whether you might be dealing with someone who has sanctions attached to them, there's a consolidated list that gives all individuals and entities subject to asset freezers under the UK and under the UN and UK sanctions. We will circulate these notes and other notes, supporting notes, to give you the links to those. And there is an additional list around entities subject to capital market restrictions as a result directly of the Russian invasion. Again, we'll circulate the link. Certain entities, such as ourselves in the professional services sector, largely those in a regulated sector who would be caught by anti-money laundering regulations as well, have to report on these, on entities that they come across that are sanctioned, that they might have worked with or be considering working with. It is separate. While I say it's the same firms largely who are subject to anti-money laundering, it's worth noting that they are two separate bodies and two separate requirements, so making a report to one doesn't cover you for the other. If you think you need to make a report from a money laundering perspective, you need to do that as well as any sanctions reports. And then in terms of Russia, I don't propose to spend lots of time on this because I'm sure you've all heard lots about it, but largely since the invasion of the Ukraine, there's been a number of new sanctions announced pretty much daily for a long period of time when it first started, and they're still happening now. There's different kinds of sanctions being actioned against Russian individuals and Russian entities, so obviously there's lots to unpick there and there's a lot more focus. The other thing to say is obviously because there's increased focus and because there's an increase in the amount of sanctions, if you are taking on new clients, looking at working with new entities, there is a heightened risk that people may be trying to conceal identities or conceal ownership. So you just need to be aware of that and make sure you are unpacking all of that to do the appropriate checks. In terms of if you do find that you are dealing with someone who is sanctioned, you need to identify any assets held and freeze those. You need to cease acting and you need to make a report. But I would say before all that, I would seek some legal support just to make sure you are doing all the right things in the right order, because it can be a tricky thing. Okay? And that's it for me. So a bit of a whistle-stop tour for you.
So I'm James Piper, the founder of Flyball Credit. Firstly, thanks very much to Parry, Danny and Steve for inviting me down. Briefly, my background is I'm a qualified corporate treasurer. Very interesting, I know. My background is at largely Barrett Developments, the house builder, back in 2008 when the economics talk earlier spoke about the last crash. I was enjoying the benefits of that. It was a very pleasant time. I've then gone to work in private equity, doing restructuring, focusing on working capital, trade terms, refinancing. My business, Libel Credit, focuses on providing a whole market solution and giving insight on trade credit. Ratings matter now more than ever. Some of you will have just filed your December 21 numbers, and they'll have hit the agencies at the last week of September, so you're probably hearing some noise from suppliers or when you tender for work. Trade credit ratings impact your working capital, so the terms that your suppliers afford you, whether it's 30 days, 40 days or pro forma. Raising finance and leases, so largely Experian scores are used in the company cars and tier 2 finance. Utility pricing, as the HSBC guy spoke of earlier, energy prices have rocketed, the market and the supply base has shrunk considerably, therefore your previous provider has probably gone into insolvency and you've been migrated to a new provider. That new provider will be running a credit check on your business, firstly on the rates that they're going to give you, but also around the security deposit they may ask, and challenge sectors such as hospitality, and we've got a client who's got a leisure centre. Not only have they increased his energy costs, but they've asked him for a £200,000 security deposit at a time when he really doesn't need to be paying £2,000 into a security deposit. Tendering for work, and this goes back to my time at Barracks, we couldn't really buy land for a period because our outward facing credit ratings were so poor that anyone who contracted for us to buy land in 8, 12, 2 years time didn't trust that we were going to exist. So more ratings, more credit reports are being run now than at any time in history, and that's a cocktail of probably 2 or 3 things. The economic point that we're at in the cycle, downturn, people being more risk aware, more risk averse, and also the agencies have upped their game, and the web-based portals that they provide are pretty decent, to be honest. So, we work with all of the main agencies. Hopefully these names will mean something to you. So CreditSafe, Experian, Equifax, Graydon, although recently they've been purchased by CreditSafe and that data's going to merge, Dun & Bradstreet, and the new kids on the block, Red Flag Alert. And what we do is, in providing this whole market, is that the traditional view for a business is to buy a rating agency portal such as an Experian license or a CreditSafe, and I encourage you to do this, this is great, but focus out on your customers, your suppliers and your peers, but it's all outward facing. What we do is we turn all of those agencies in on your business, because each of those different agencies will be whether they're providing you working capital terms, who you're tendering with, so having a whole market view at this point in time is proving really, really valuable. I want to do some examples of stuff that we've done previously. I don't really want to talk about too much about that sort of stuff. Case study 1. So we did an SME restaurant business based up in Scotland, turnover of 1.5 million. He'd applied for some funding. His experience score was 5 out of 100. Firstly, he files a breach of accounts. He's in a challenged sector, and he got some poor payment performance in his history. We were able to share full year-to-date MI, full statutory accounts, all under an NDA, so none of this formed any more of his publicly viewable data. And the rating agencies take a view on that, and we managed to improve his rating from 5 to 89, which enabled him to go and buy a new site and fit it out, and you know, still a client of ours, fast-growing business in a sector that's challenged. It's got some headwinds around how the sectors are viewed, how the agencies want to give credit and recommend limits, and the funder that sat behind that had an algorithmic scoring decision basis that just said if you're below 45, we're not going to proceed with your application. So knowing your ratings, if you're looking at that tier 2 finance, is key. Case study 2. So a private equity firm that we work with was carving out a business into a new co because there were some VAT liabilities and they didn't see it as a core part of their business going forward. Any new code that's registered at Companies House will be given a credit rating of somewhere between 30 and 45 and a recommended credit limit of £500. A bit different when you've got an 80 million day one turnover with 10-year recurring revenues, because it was contractual business. It was purchased, they put some loan notes into it which had impacted the balance sheet, but we were able to share that information with the agency because they weren't going to file, they were going to trade for 12 months, then they've got 9 months to file their accounts. 21 months of being on £500 recommended credit limit for a business of that size wasn't really sustainable. So we shared the carve out, we shared what had happened, the group structure, the transaction that had taken place with the agencies. And this agency in particular, quite mean, they went from 50 to 150k, Slightly more generous agency 2, 210, 610, and our favourites went from 4k to 1.4 million pounds. Enabled them to buy a whole new lot of mowers, because it was a grounds maintenance business for the MOD and all that. It really made them be able to go and win new work, get the working capital in the business, and it enabled them, especially on their funder, the PE firm is behind that, saved them putting about £7 million of cash into the business for working capital day one. Okay, 3. Logistics business, yeah, tendering for work. This is with Dun & Bradstreet. So the overall business risk, when you're tendering for work, you need to be in this low, moderate risk band. If you're in moderate, high, or moderate, you're going to fail on sort of a lot of these framework agreements. We shared the information. It didn't move the credit limit massively. It actually didn't move the failure score greatly. And the higher your failure score, the better. I still don't understand that. Equally with delinquency score, if you've got a delinquency score of 100 out of 100, you've got a really good business, and counterintuitive to me. We were able to share again year-to-date MI, speak with the analyst and explain what's going on in the business, show the contractual revenue that they really, really like, because you've got 70-80% of your next 2-3 years revenue guaranteed, and in a wet signature contract, makes a huge difference to the credit ratings and limits that afford your business. So, we provide free credit insight. All of these agencies, that's totally free, and we work with Coopers, and we had some clients where we did one in Birmingham last week who requested the report afterwards. We're happy to provide that. Myself and a couple of the guys from the team are here. We can provide you all of your ratings, how they've changed in the last 12 months, the current number of searches that are being run against your business, how you're perceived to pay your suppliers, all of this information in a single document, and it takes about 3 minutes for the API to run. It's very technical. Olek will be able to explain that far greater than me. And that is completely free. Then, if there's areas of concern, and we had a couple of clients that come to us and successfully engaged from last week's presentation that we did, if there's something that you don't understand or you want to know more about, we're happy to have a walkthrough talk and a call to go through that. And then if we can help you and improve that, then we'll do so on a success fee basis only. Going forward, here we go, just going to break it. No, there we go. So, we provide this for companies on a 60-day free trial for Coopers, for CP clients, we do anyway. If you want to see how these agencies report you in real time, so you get on-the-day alerts, I'd say expert advice, that's the OLEC element of it rather than me. Insight, so understanding why these agencies have changed. Payment data is key for these, especially at the lower end of the market, where if you file a bridged accounts or limited data at a company's house once a year, the rating agencies are effectively taking payment data from your customers about how you pay them and using that to impact your credit score. But a lot of this information that's uploaded to the agencies, and I'm not here to bash the agencies, they do a fantastic job with the data that they've got, but it can often be out of date and poor and reported against the wrong entity. We had a client just yesterday who's 120 days past due on his credit report, is showing. When we challenged that, we found out it was I won't name the company, a phone provider, and they'd uploaded the data against the wrong company. And his credit limit had dropped from 78k down to 4k on the back of being reported as delinquent 120 days past due. So whilst the agencies are taking the best information they can, it's certainly not perfect.